Hello and welcome to BloombergQuint. Just as you thought that monetary policy was becoming a touch predictable, 125 basis point rate cut followed by another, same story, growth is weak, inflation is steady. Well, you got one out of left field. The MPC has kept interest rates unchanged, and what's equally surprising is the unanimous vote to keep rates unchanged. They have, of course, left the window open for further rate cuts. Joining us to talk about today's decision and the road ahead, Pranjul Bhandari, Chief India Economist at HSBC, and Ananth Narayan, Professor at SPJIMR Institute of Management. Thank you both so much for joining us. Pranjul, let me start by you. Certainly shook us all, commentators up awake, probably the same for all of you economists.
Yes, indeed, it did come as a shock, but in retrospect, I'm seeing some merit in what they did. I think the macro package confronting the RBI and all of us now is quite different from the macro package in the last policy meeting. Inflation is up. Growth seems to have bottomed out, even if it won't accelerate at this point. So it's a very, very different situation. But I think more importantly was the whole transmission and what he called optimal timing of the next repo rate cut. If the RBI keeps cutting the repo rate and the transmission doesn't happen and all the spreads remain elevated, then there is a problem. Look, the markets always takes cues from the RBI, but actually even the RBI takes cues from the market. If the RBI keeps cutting rates and it never gets transmitted, then the repo rate will lose its relevance really. So I think from that perspective, this whole optimal timing of the next rate cut makes sense to have waited out this time. So, I'm making my peace with it, but I think not a bad decision.
All right, I'll come to some of the fine print of the eco data. But Ananth, what did you make of it? I know I can imagine a bunch of your friends in the debt market sitting in trading rooms would have been, not particularly thrilled at this.
Not at all. In fact, the bond markets reacted pretty violently, I would say. More than the bond markets, the swap markets also reacted pretty violently, 25 basis points or so move, and it doesn't look like it's over. Look, this was a surprise. I don't think any economist or any analyst, at least publicly, called for a no change in rate policy. To that extent, a 6-0 move for no change is a complete surprise. I agree with Pranjul. If we ignore the fact that this MPC has been particularly dovish and accommodative, and if you ignore the fact that in the last policy they actually said that they will stay accommodative as long as it takes for growth to revive, we've sort of attached when in doubt this MPC will be dovish kind of an outlook. That's been challenged right now. But if you ignore that part and you look at the complete context, inflation is high and looking very, very tricky. Your fiscal deficit is looking, the balance has for a while it's looked difficult. It's looking particularly difficult now with low taxation and a lot of expenditures. And while growth is a problem, I've argued with you earlier, Ira, that I'm not sure how much of rate cuts could really help in the growth situation. So in that complete context, given that we've already had 135 basis points of rate cut and that we've now flooded the market with banking liquidity at least, there is a case for a pause. I guess we were all taken in by the fact that we expected this MPC to err on the side of being dovish, and practically nobody expected that the MPC would shock all the analysts by going completely against what they were expecting. So yes, bond markets have reacted violently. One last point I'll add, Ira, is that I think the fear that the bond markets will go through is, what is it that the MPC sees or fears that has allowed them to go 6-0 into a pause at a time when everybody else is expecting a rate cut. That's the only fear that will kind of persist for a while now.
No, absolutely. And let me get straight into that. So, Pranjul, so what do you think they acted on? I mean, the minutes will throw some light. Did they act on the inflation numbers and say that, look, we are in a formal, while it is flexible, but we are an inflation targeting framework. We don't want to undo the gains of the past few years. Did they act on that? Did they act on the expectation that the fisc is going to be wider next year, because they did mention budget? Or did they act on, as you say, the fact that transmission is not happening?
Ira, if you isolate any one reason, it doesn't look powerful enough at a time when the output gap is very large. By our estimate, it's 1%, which is fairly large. I think it's the package. It's everything come together. The fact that inflation is high, it wasn't in the past. The fact that growth has bottomed out after a very long time, at least by a lot of people's forecasts. The fact that fiscal uncertainties, everybody starts talking about it more at the end of the fiscal year, that's going to come up now. The fact that transmission is not really happening even after the 1st October change, I think that package is a very compelling package, and I think that made them pause. But, taking a step back, it does signal the fact that, we're towards the end of the rate cutting cycle. I think that signal became very clear today, and I think that's the signal that has spooked everybody. Like, people used to talk about it that, yeah, maybe not too many rate cuts from here, but hearing it from the RBI in this way is what I think has spooked the bond markets today.
Ananth, you don't think they erred in the sense that, the economy is very weak. They do have the flexibility to stay even up till 6% for a period of time and then give a roadmap to come back to 4%. Do you think they erred? I mean, surely the economy doesn't need a message saying that, okay, you don't have much room for monetary policy accommodation from here on.
Well, personally, and I know this is going to be unpopular, but personally, I'm not sure they've erred. I would argue that they were right in being cautious at this point in time, even though, like everybody else, I was expecting a 25 basis point rate cut today. And I'll tell you why. Look, there are question marks about how inflation will pan out going forward. You're right, they have a 2 to 6% flexibility, but given that there are statistical base effects at play, and given there are funny things happening with food inflation, it's quite possible that over the next 3 months going into Jan, we could see a shocker of an inflation print, maybe at close to the 6% mark. When I say that the bond markets are worried about what the MPC can see, which we can't see, this could be one of those fears. Maybe we see a shocker of an inflation print, at least transient. Second, core inflation, while the base case expectation is that inflation should subside and come back to the 4.5% mark or so by March, there are signs that even core inflation could be under risk. For instance, food prices going up is actually augurs well for the rural economy, and maybe we see some support from consumption and therefore a bit of inflation, good inflation coming from there. Second, government spending has increased. We saw that in the last GDP numbers as well, and they seem to be releasing funds. Third, we are seeing things like the telecom sector and maybe even automobiles. There's talk of actually repricing coming through, given that demand seems to have kind of troughed and will probably go up from here. So one really can't be sanguine on this inflation front. And more importantly, I'm not a fan of inflation targeting, as you know, Ira, but from the growth front, yes, things are not looking great, but I'm not really sure that this complex of fiscal monetary easing is what is really required at this point in time. Let's not forget, we've seen 135 basis points of rate cut already. We've seen enormous amount of liquidity being pumped into the banking system. While we think that the fisc is being too tight, in reality, looking at the center, state and public sector borrowing, I'm seeing that borrowing number at close to the highs for the decade, at close to 10% of GDP. That's an enormous number and far higher than the household savings. So a lot of fiscal and monetary support is already in play. Now, asking for more at a time when serious structural issues are staring us in the face, in banking, in NBFCs, power sector, real estate construction, don't get me started. I think we are kind of flogging a wrong horse, the wrong dead horse. It's much more important that we stop, discussing the fisc and the monetary policy so much and start working on the real reforms that the economy needs. To that extent, I think this pause is quite welcome, to be honest.
Pranjul, to be fair to them, they did say that this is, the room is, there is room for further rate cuts. I think twice Governor said this is a temporary pause. But what would be the conditions that would get them to press the trigger again? Presumably, growth is not going to worsen from the 4.5% that we saw in Q2. So would it be inflation coming in below what their targets is, or would it be, perhaps a better fiscal behavior than what they could be fearing?
Yeah, I think they'll be looking at three things, and I think all these three things will be obvious in February. One, when a new vegetable crop arrives in January, February, will food prices really fall or not? And this is important because, the sense is that vegetable prices have shot up because of unseasonal rains, and therefore vegetable prices are up. But the truth is that there are a lot more food items like egg, meat, fish, pulses, milk, which have been going back even before the vegetable price shock hit the market. So you'll have to see how that part behaves. That's 1/3 of the food basket. So I think in February they'll get a sense of, what is linked to vegetables and what is beyond vegetables. That's one. The second is the green shoots that they spoke about. They seem to be seeing signs of capex recovery, which honestly I'm not seeing right now. But we'll have to see, do they sustain, do they strengthen, or do they just fade away? So that's the second thing I think should be obvious in the next couple of months. And the third, of course, is the fiscal, as even Ananth was saying. On 1st February, we really know what is the slippage for the last year, what's going to be the sense for the next year, how do the assumptions look, what are they doing with their nominal GDP growth target, gross tax revenue target, disinvestment target, how credible are those numbers. So I think all of that will be clear in February. So I think these are the three things that they will be looking at.
Okay, Pranjul, I don't know if we have Ananth back. We lost his audio for a minute. I'll go back to him, but let me put the question to you. Do you think at this stage, having done this, will it not hurt transmission even more? Because now it generates a certain amount of uncertainty as to the next move. Plus, you've seen the long end of the yield curve move up because of this. So in many ways, this sort of hurts transmission, and the external benchmarking happened at a time then when most of the rate cuts had actually preceded it. So, from here on, the benefits of that will also moderate.
Good point, Ira. But this whole transmission issue can't hold RBI monetary policy hostage. Then the sense will be that the RBI should never stop cutting rates for transmission to happen. The truth is that transmission takes 2 to 3 quarters. A lot of rate cuts that have already happened haven't yet got transmitted. There are a lot of balance sheet issues, but there are just the genuine delays also. The fact that the deposit base takes time to reprice. So I think even though they have not cut today, just the normal course of events that over time the deposit base will start getting repriced, and then that will help bring down the lending rates. I think that should continue. Maybe there won't be an extra kicker from today, but what they've been doing over the last 9 months, I think that process and the fruits born out of that process should still come our way.
Ananth, what I was asking Pranjul when we briefly lost you was the question as to, you pause at this stage. Do you not end up creating more uncertainty in the minds of, say, banks as to how they should price credit forward? From a bond market perspective, your yield curve has steepened even more. Your 10-year going up means that transmission even at the long end of, so credit markets comes off.
Yeah, true, Ira. All the points are valid. Very quick responses. You're right about uncertainty. For instance, personally, I struggle to see how the MPC will deliver a rate cut in February. I know we'll have the budget behind us, and maybe we get some magic on the fiscal numbers, which gives everybody a lot of relief. I don't see that happening as the base case. But given that inflation is likely to be in the 5% handle at that point in time, if we couldn't cut when inflation was at 4.6%, I don't see how rate cuts can be delivered at 5%. And let's not forget, I think one of the big issues today was inflation expectations going up to as high as by 180 basis points. So that remains one big uncertainty. On the question of transmission, look, here's my quick take. I think Governor Das was right. Actual transmission into money market rates has been very, very good. In fact, 1 year CD rates have come down by 250 basis points. CP rates have come down by over 200 basis points as well. Good NBFCs are raising monies at short-term money at close to risk-free rates. To that extent, at least money market rates transmission has been awesome, especially with this excess liquidity in the system. I think a couple of things. One is, I think banks have been a little tardy on passing on this money market rates, lower money market rates onto the deposit rates and then to the lending rates. And here's my point. CD rates, while the markets are small, are a good indicator of where they can raise incremental money from. And that's come off by, as I said, 250 basis points. After that, if you've only cut deposit rates by 50, 60 basis points, I would argue that there's something wrong in the transmission being done by banks. Secondly, I think the fact remains that while good NBFCs can raise money at close to risk-free rates in the market, there is a lot of trust deficit about lots of balance sheets. Now, you can't address a trust deficit issue by lowering risk-free rates. That doesn't solve the problem at all. So, we're probably trying to beat up the wrong horse to address the wrong problem. You've got to solve this issue of trust deficit, and there's a limit to which monetary policy can help in that process. But I would argue it can't help at all. On the last point, therefore, overall, look, I think the markets are going to be uncertain going forward. We will watch for the November print of CPI very, very closely, and at least try and allay the fears that maybe the MPC could see something that we couldn't, and maybe hopefully we don't get a shocker of a number. Otherwise, we are in a bit of a tough spot. Inflation higher than we would like it to be, growth far lower than where we would like it to be, fiscal deficit looking already pretty stretched, not a good constellation of factors to look into for the next few months. And yes, therefore, uncertainty on rates as well as transmission will remain.
Okay, two last questions. Ananth, I'll stay with you and then come to Pranjul for the last one. From here on, Ananth, the fiscal becomes a focus from both the market perspective, in the sense that if they do go way above their target, there's risk on the bond markets, on rates, etc. But equally, on the growth side, it looks like, the message was that, look, monetary policy has done a fair amount of heavy lifting in the early part of the cycle, and now perhaps fiscal needs to take over. That's a sort of a tough balance to strike, right? Somebody has to lose in that game.
Yeah, it's a tough one. To be fair to Governor Das, he didn't give the harsh message that I'm imputing. He was very clear this is a pause, that there is more scope for cutting rates. That he didn't indicate that the cycle is over and the ball is now in the fiscal court at all, at least not as far as I could see. Here are a few things which could pan out. On the fisc, look, I think we're in a tough spot. While we are hoping a lot from disinvestments, pointers, it does take time to do these large-scale disinvestments. At any rate, doing large-scale disinvestments to fund what is effectively a revenue deficit is not really healthy in that sense. In that sense, the overall fiscal deficit and government borrowing, I don't see how it will come down in the next few days. On one thing that the RBI could do, which the governor didn't address straight away, was can they actually intervene in the bond markets and keep the term premium and bond yields kind of under control. I do think that while there was no clarity which emerged today, at some stage, if bond yields were to start going up and maybe come close to the 7% mark or on the 10-year bond, I think the RBI will seriously consider intervening to ensure that bond yields are capped. It's a personal view, I could be wrong. The room for doing that, though, could be seriously tested if inflation starts to pick up. I do hope we don't get some really awful inflation prints, because that would be the last thing we want right now. Barring that, I do think RBI will be open to intervening in the bond markets if it's required to do so.
Yeah, I think when he was asked about Operation Twist, he sort of just said, this is not stuff that gets discussed in public domain. So, maybe that is not ruled out. Pranjul, last word to you. So, one thing that's being discussed is that, 6-0 vote for a pause. Does the committee know something the rest of the world doesn't? Is there some big action coming from the government side? Are you building in any large government intervention to, to help growth pick up? And if not, then are we looking at a lower for longer kind of growth scenario, which some of you have already predicted?
Well, look, the truth is that, they can announce something very big, like the TARP question that was asked to the governor today. And maybe we hear some announcement from the government. But things like TARP, which work very well in some economies like the US, may not necessarily work very well in India for all kinds of operational issues, bureaucratic hurdles, what kind of sectors, who will make the decisions, who will do the final sign-off. If operationally things would be so easy, then the 250 billion rupees that, the last mile real estate fund that has been announced would have been operational by now. These things don't work very easily in India. So even if something big and big bang is announced, I would sort of not become very excited overnight about it. What can then be done? Well, there's a lot that can still be done to clean up the balance sheet stress that we are seeing in the books of banks, shadow banks, corporates, and so on. For example, the IBC is a great law, but the incentive structure is wrong. Try to correct some of that, sending more cases to the IBC, dealing with the Section 29A at this point, perhaps removing it, ensuring that things happen in line with the timeline that have been prescribed. I think these are very, very important steps. Then we have so much of stalled investment projects. Many power companies are stalled because they still don't have access to coal, resolving those things, actually getting the disinvestment done. We've been hearing so much about it. There's just a lot of things that can still be done even without announcing a big bang sort of TARP thing. And I think that is what we need to move ahead at this point. Just one last thing on slowdown. Why did we get a slowdown? I think there's a big structural reason, and then there's some cyclical reasons too. I think the big structural reason is the fact that there's just too much stress in the balance sheets of the big economic agents at this point. And are we doing enough to remove that stress? Perhaps not yet. We are making the right noises, but perhaps we're not operationalizing them very well yet. But there are a few other things that led to the slowdown. For example, global growth was weak. The fact that there was pre-election uncertainty, there was uncertain monsoons through the rainy season. Those things could improve next year, and growth could tick up on the back of that. And I do have that in my forecast. I have growth at 4.9% this year. I have growth at 5.9% this year. The good news is it's an uptick. The bad news is that we are really far away from the 6.5% potential number that we think we have at this point.
All right, that's a good note to leave it on. Thank you both so much for taking the time to speak to us on what has undoubtedly been a busy day for both of you. Thank you. Appreciate you speaking to us here on BloombergQuint. Thanks for watching. Do go to BloombergQuint.com. We've got a lot of views and, of course, all of the news from monetary policy.